everyone. You can also take this time now to say hello in the chat. Yesterday, you've done such a great job with, welcome messages and also sharing where you're from, as we have really, really diverse group of participants, which is absolutely amazing. So I see a lot of hello messages. Super. Hello, everyone. Super. And dears, before we will start, actually, just one important information. So, dears, please kindly remember that we are meeting in the CET time zone, right? So every time that you will see the hour, it's also mentioned in the messages that you are receiving. But I also received a few questions and concerns about the joining hours. So please always remember that we are providing you the hours in CET time zone, right? So this is super important to remember. And yes, please kindly try to use your name and last name when you'll be joining the session in the Teams. Of course, one registration is enough, so there's no need to, register for every day for the sessions because we have your registration covered. Yeah, and also in terms of the certificates, so this was also mentioned, but just a kind reminder. So you will all receive the certificate. Just please, if you could attend at least 6 sessions, and your participation will be checked. We as so myself and also our producer Justin, he has the access to the reports from every meeting with the with the time when you joined and so on and so forth. So we will be comparing this based on that. So some calculation will be made. Yeah, so it's not taken like out of the blue. Just please kindly, that's why remember to put your name and last name in your when you be logging for the meeting. And I see that we have even more participants. So hello everyone once again. And before we will actually kick off with our session for today. So today will be the first session dedicated for. Of course, yesterday we had this session, but it was like great opening session. So you were able to meet our leaders. We had also this nice quiz. And sorry, I just see one question. Well, with one registration, it's enough. I mean that when you register to this program, right, through this website, so probably you have seen the link in the email or maybe in some social media promotion, and that is why then you receive the invitation for the meeting. So I mean that you don't have to register. I think that even you'll not be able because your registration is captured once. Just please, when you'll be joining the session in Teams, if you could kindly put your name, last name. So yeah, Nazira, I see your name. So that's working well. Okay, so Justin, maybe we can start with our networking activity. So if I can kindly ask you to put the word cloud pulling. Super. So, dears, the question for our icebreaker, warm-up activity is, what is the one word that actually describe how you are feeling today? You can also try to include emoji. Let's see, maybe this will work. So let's say that one word or emoji, if you prefer. Uh, and if for some of you the word cloud, the pool is not working, you can also use, of course, the chat. I see in chat we have some emojis, excited, passionate, super motivated, busy, wonderful, busy. So busy times for all of us. Super. Thank you for this comment about the voice. Incredible, motivated. I see in our word cloud as well, calm, amazing, excited. I see that excited is actually in the center of the word cloud. So it means that most probably more participants included this word, but we also have sleepy, tired. So dears, I hope that overwhelmed with studies. Sorry to hear that, and I hope that you'll get some rest time today, and also the weekend. We are approaching slowly, but towards the weekend. Excited, tired. Tomorrow I have test to you. I wish me luck. Super, of course, we'll be keeping fingers crossed for that. Swamped with work, positive, motivated. So overall, I have to say what I see, that you are excited, motivated, happy, but also a little bit tired, right? And sleepy. So dears, definitely, please take time during the weekend to rest. We'll have some question about weekend plans, but maybe, during Friday session. So it will be also, I think, inspiring. And I'm very good. Thank you so much for this question. I see in the chat. Okay, dear. So very good. Thank you for all of your answers. Yes, I will share the link to our LinkedIn group. And dears, I would like to now hand over the stage to our great speaker, Aurora Alikai from Greece, from EY Greece. And Aurora, it's actually joining us. It's her another edition of this program, so we are very happy to have her on board. And today workshop will be about business valuation. So Aurora, the floor is yours.
Thank you, Magdalena. Thank you very much. First of all, I want to thank you, the audience, for joining the call. If I have people in the call that would feel comfortable to have a video, just to make it a bit more interactive, it would be good. Don't be embarrassed. I would say there is no reason to be embarrassed at all to put the video. Up to you, whatever you feel. I don't know, Magdalena, if you had discussion with the audience, if we keep the questions, because I'm sure that certain questions will arrive as we go by the workshop. If we can keep the full questions at the end.
Super. Let's agree for this. Yes.
Okay, so my plan is to cover, first of all, the topic and the slides, that the presentation, and then we can have, I will try to be fast and quick, and then we can have, we can give like more than 20 minutes to discuss whatever the audience prefers.
True, let's do this. And I see
Okay.
also a lot of hearts, so I assume that our participants also like this approach.
Okay, that's perfect. That's perfect. Well, first of all, I want to thank you, everyone, and let everyone know that it's a pleasure. It's a pleasure from my side as well to be a speaker today regarding the business valuation topic or workshop, whatever we want to call it. And it's very interesting because you take me back in the years, reminding me the school years as well. So this is quite interesting from my side as well. And of course, to see how the generations, as time flies, how the new generation changes, what new things they learn, you guys learn in universities and so on. If you can move to the next slide, Justin.
Just quickly before we start, I think Tionita has her hand raised. I think she has a question.
Okay.
If she can maybe come off mute. Well, I guess not.
Probably she has left it by mistake like that. Okay, that is fine. That is fine. Well, first of all, I want to introduce myself so you know who I am. My name is Aurora Alikai. I am a director in EY Greece in Strategy and Transaction Department. I've been with EY the last 9 years. Prior to that, I was in Deloitte Tirana for 2.5 years. I'm multilingual. I speak Greek, Albanian, and English. And relating to the education, I've graduated my bachelor from the University of La Verne University in California in United States. Then after I graduated for my bachelor, I transferred in Michigan and finished my master's degree at Walsh College of Accountancy and Business, Michigan. In 2015, I've completed as well the ACCA certificate. And then it was time for me to move on and start working in my profession. What do I do in terms of professional experience? I have more than 10 years of experience in corporate finance, basically leading and delivering business and intangible valuations for different type of purposes. It could be mergers and acquisitions. It could be reorganizations, tax and regulatory compliances. It can be for management purposes. Just the management wants to know what their business or an investment that they are aiming to perform, how much would it value. And on top of the business valuation part that I provide, I do as well. I perform as well feasibility studies, financial modeling and financial feasibility studies, which we do this in the last 3 or 4 years, I would say, for funding purposes, for major big clients within Greece and CESA region, in order for the clients to receive potential grants. It can be from EU direct funding, it can be from state grants, etc. And actively, I'm managing and leading projects within the within Greece, as well as multinational clients at CESA region, in different kind of industries. I'm not focused in any specific industry, but I can handle and I can lead different kind of industries: TMT, power and utilities, healthcare. We are not specialized within Greece in specific industries yet. If we can move on, please. When you guys hear about, as I said, I am a senior manager in valuation modeling and economics. When you hear valuation modeling and economics, we generally refer to it as VME, which is valuation modeling and economics. As I said, the valuation part, it's what I'm covering. It's a topic that I will be covering today, the business valuation, and we will see different things inside this workshop. M stands for financial modeling, and what we do basically in financial modeling, we build from scratch different financial models, which can be for capital raising, or it can be for infrastructure or project finance purposes. And the economic stands for economic advisory, which basically there we cover economic impact assessments. It can be regulatory compliances, feasibility studies to see potentially what kind of impact a specific investment would give in a certain country. If we move on, please. And as part of the agenda, I wanted to go over quick with you so you have a feeling what we will be covering in the next slides. And the way I have presented, I have compiled this presentation is to go over first some kind of literature of business valuation so that you get a bit more familiar with terms and business valuation concept. Then we will go over in a real case valuation, which I've taken from our past exercises that we have done. But of course with anonymous names and confidentiality and so on. So the first thing when you hear about the valuation, we should keep in mind, all of us, including me as well, that valuations are subjective, but it is our role as valuation people to apply the knowledge to develop a valuation as unbiased as possible. So in this context, the way the presentation is covered, we will talk about the purpose of the valuation, standard of value, what methods are applied in order to derive a valuation exercise, what factors are considered when we perform the valuation exercise. We take some management accounts, but then we should start and analyze and perform some detailed analysis on certain factors. And the last thing I'll go over, as I mentioned, through a report structure, so you guys have an idea how our deliverable, when we compile a valuation exercise, we come up with a written report. how this report looks like, this is the deliverable part at the client stage, and then we'll go over a quick exercise, a presentation with evaluation report so that you get somehow familiar. If we move to the next slide, I think we have a poll question before the slide. If
Yes,
you
I'll
can move
launch it
it.
now. Mhm.
I just wanted, so it just helps me for the presentation, what kind of experience you have in business valuations. If we have heard of it ever, if you have heard about revaluation approaches, if you guys can perform, if you touch base it in the school, or we may have an audience that they might be even experienced appraisers. Okay. Should we give more time, or we can close it? Do we have other people still replying? Okay. Okay. I think we are okay, right? Justin, to
Yeah, we can move on.
we just want to, I just want to have a feeling, so it's good. I realize that we have that at least the audience, the participants have heard of of business valuation, what it is, and I'm really impressed that you know even the methodologies. This is quite interesting that you know that there are 3 methodologies to perform a valuation exercise. So it's quite interesting. Moving on, let's discuss what is the purpose. So we all understand what's the purpose of evaluation and why do we do it. When we hear when a client approaches us to perform evaluation, the first thing that comes on our mind, why does the client is looking? What is the client aims with this valuation exercise? Where is he going to use it, to utilize our report? The first reason of performing evaluation exercise is to determine the present value of the company, investment or an asset. And there are different types of purposes. It can be for negotiating a deal. It can be for M&A purposes. And I'm very sure that you guys have heard a lot of it, that evaluation exercise is performed when we have an M&A scope, mergers and acquisition scope, in buying and selling an asset. As financial advisors, we at EY can take both sides. We can support the client on the sell side, or we can support the client on the buy side. Both parties will come up depending, because different views will have the seller and different view will have the buyer. Of course, the seller wants the highest possible sell outcome, where the buyer wants to have the lowest possible value of the business in order to close the transaction. Another reason why we perform valuation exercises could be for capital, for debt raising, finance raising. Basically, one of the objectives to see is when negotiating with a bank or with lenders or potential investors, they want to see some documentation, and documenting what the company or what the business is worth of and is valued, and to present as well what's the ability of such business to generate cash flows in the future. It enhances credibility. So we have a lot of cases that we want for equity debt finance to be accompanied with evaluation exercise of the specific, either for the business, either for a new investment, or for whatever purposes that the client is aiming to increase, capital finance. Another purpose could be for financial reporting. I don't know how familiar this could be a bit more advanced. It can be for impairment test purposes, which we do a lot when the auditors are very close to closing the financial statements and providing opinions. Certain clients, depending on if there are triggering events, may require evaluation review or may require impairment test purposes. So in this context, we review the valuation done by a third party, because we cannot provide valuation review on audit clients. And then we can come up with an impairment test review as a scope for the audit purposes. Another purpose could be purchase price allocation. This is even more advanced exercise for the purchase price allocation, which is in line with IFRS 3 for business combination. And when is this required? It's required basically when we have company A acquiring company B. Company B is the target. And basically what the IFRS 3 tells us is that we need to perform a purchase price allocation, which is a valuation exercise basically, and we bring the balance sheet of the target at fair value. Then other purposes that the valuation exercises are required are for tax or restructuring purposes, for cross-border selling deals, or determining the impact of potential restructuring or refinancing strategy. And then there are as well could be other potential purposes why evaluation is needed. It can be purely for management purposes to know where the business stands. It can be for an exit investor. It can an investor within a company, and they want to have an exit strategy. They want to know how much their share is, so they may require a business valuation. It can be for litigation support. It can be for bankruptcy or liquidation, etc. I've included a phrase here: valuing a business is part art and part science. And I think I've put it as a poll, if I'm not mistaken, Dustin.
Yes, it's launched now.
Okay. Why do you guys think valuing a business is part art and part science? It's not an exact science, the valuation exercise.
I think the part art, part science is for slide 6. This one here is when
It's later.
yeah, this one here is
Okay. So,
when
okay.
is business valuation needed.
Okay, apologies. I moved to the poll question. Okay, so based on the discussion that we have, what do you guys, if somehow it was clear, when is this needed? When is a business valuation needed? Or in general, it can be equity evaluation as well. Okay, perfect. Perfect. Okay. Yes, that's pretty much what we have. Okay. I believe we can move on.
I can launch the poll now for why is business evaluation more art than science, because it's meant to be here.
Okay. Why do we think that valuation is part art and part science? Okay, if I can explain it as well. The reason, the truth is that valuing a business isn't always a simple and straightforward exercise process. There is also a range of reasonable outcomes. And when you will see in the presentation, in the example that I'll provide later on, you will see that the value results are as well presented as a value range. We never come up with a fixed, exact, precise number. You will never see a single number on evaluation report. By definition, the value of the business is determined by properly assessing the relationship between the future returns to be generated by the business or the investment and the risk associated with these returns. So that's why we say that it is part art and part science. It's a combination of all of them. And the more valuations we do, the better we get at them, and the better we become at justifying all the assumptions behind it. I guess we can move to what are we valuing, right?
Yep.
Okay. As I mentioned priorly, when we are approached by a client and they come to us and say that, listen, Aurora, we are looking for a valuation exercise. They inform us what the purpose of the valuation is. We understand what the purpose and what we mean by the purpose is that we understand where our report will be utilized, to whom is our report, who will be the end reader of our report. Then the next thing to do is to understand which interest is the client asking us to value. Is it a business valuation, it is an equity valuation, or is it an asset valuation? So this is quite important to make the distinguishment between the three: business, shareholders value, or asset valuation. The business value refers to the total invested capital, as the word itself says, business, and it represents the value of all capital providers. It can be shareholders and debt holders. Generally, in our language, when we say business valuation, we refer to enterprise value. And enterprise value looks at the entire market value rather than just the equity. So all the ownership interest and asset claims from both equity and debt providers. And as a formula, the enterprise value is equity value plus net financial debt of an entity, where the shareholders' value is basically considers the total value of the outstanding stocks for a company. For public companies, this is more straightforward. It's the stock price per share multiplied by the total numbers of outstanding shares. On the other side, when we want to calculate as well the equity value of a private entity, we utilize whatever methodology we can for the shareholders, not what we can, but what based on the available data that the client can provide us. And the equity value reflects the enterprise value less any net financial debt of the company. Where the asset value, basically the asset value can be tangible asset value or intangible assets value. Probably you have heard about, in the tangible asset we have we can come up with valuation of capital equipments, machinery, equipments, inventory, etc. Where the intangible assets basically relate to trademarks, patents, contracts, customer relationship. So it's a different kind of valuation that we perform specifically for asset valuation. If we can move on. So after we've clarified with the client what are we valuing, we should define the type of the value. We come up to it's step by step. So we understood what we are valuing, what kind of interest. Now we should define what type of valuation is it? What standard of value? As we see in this slide, we have different types of standards of value, and different standards of value may lead to different conclusion of what a business is worth. If we go one by one to all of them to understand what's the difference between them and what they represent, because the client, depending on the purpose that they want the valuation and the standard of value, they may come up and say, I'm looking for fair market value, or I'm looking for the investment value, or I'm looking for liquidation value. Each of them has a different meaning, and each of them has a different use where we come up with this kind of standard of value. Okay. Just I'll reply later for all the questions. The first one, fair market value, it basically reflects the price that the company is worth in an open and competitive market with both a willing buyer and the seller. In this case, the buyer and the seller represent a hypothetical person dealing at arm's length rather than any specific or particular buyer or seller. The fair market value is widely recognized and accepted and accepted standard of value for business valuation, and it is mainly used for tax purposes or strategic valuation purposes. The fair value is the amount for which the asset could be exchanged or liability settled between knowledgeable, willing parties in arm's length, in arm's length transactions. In valuation, it differs from the first one, from the fair market value, because under the fair value, we consider a specific buyer. It's not any potential buyer, hypothetical buyer, but it's a specific buyer. And basically, it is used as well for financial reporting purposes. Moving on to the investment value, as the wording itself says, the investment value is specifically to entity, and it reflects the value of a company or asset or a potential buyer. It considers the entity circumstances and financial objectives, but doesn't involve a hypothetical buyer. So it's specifically to a certain asset or person. It depends as well on deal specific characteristics, including specific synergies, capital structure, transaction terms, and buyer's intended use of a certain company or an asset. Then the liquidation value by the word itself, because I think that somehow the words attached as well are related to the meaning. What do we mean by them? Assesses the company's total assets in the event of closure. Net liquidation value, basically what would be? It would be the market value of physical assets minus the liabilities that this asset has on top. Then moving to the value in use, this is a concept mainly used in IFRS for IFRS purposes, and basically it is entity-specific standard, and it is evaluating the expected cash flows that a specific asset or company is aiming to generate, used in impairment tests, basically that we perform on an annual basis, because it assesses the current state of the asset or the business, what kind of future cash flows this asset will be generating or performing. And then the book value, basically the book value is what we see if we open the financial statements of an entity, of any kind of entity, public, private. The book value is what value we see on the balance sheet as of a valuation date, as a specific valuation date. If we open the financial statements of Coca-Cola, the book value is the asset registered, and the book value is the value we see on the accounts on the balance sheet. And this is basically used for financial reporting purposes, of course, for financial statements. And generally, it tends to be lower than the market value, subject to certain economic factors, market capitalization, and so on. If we can move on as well.
Yep, we have another poll now.
Okay, apologies, I
now.
missed it. Mhm. Okay. The correct answer is 1 and 3, investment value and value in use. And I'm really happy that I see the majority of the audience has voted for that. So it's quite interesting. And I guess we can move on with the slides. We come up to the three known methodologies. So after we have decided, because I'm trying to put it in a logical, chronological way for you to understand how we do it in real life. We have understood what are we valuing. It's a business valuation, equity valuation, or asset valuation. We know what the purpose of the valuation is. We have defined it with the client. And we know as well the standard of value that the client is aiming for. So as a next step, as professionals, it's our part, our job, to sit down and discuss what is the valuation methodology that we will utilize for a business valuation or an equity valuation or asset valuation. The well-renowned methodologies, as you all have heard pretty much, is income approach, market approach, and cost approach. These are the well-renowned methodologies that are used in valuation services. If we move on to analyze and to go a bit in all of them, the first one is the income approach. I would say that income approach is, at least on our practice, is the first methodology, the preferred methodology that is widely used. It establishes the value of the business by converting the anticipated future economic benefits or future economic cash flows in present value. Basically, methodologies within the income approach are DCF, discounted cash flow method. And then depending on what we are looking for, business valuation or equity valuation, we have two different approaches, two different methodologies: free cash flow to the firm, free cash flow to equity, and dividend discount model. Let's go first to the discounted cash flow method, which basically it's an analysis performed by building a financial model in Excel format. It requires extensive effort from our part, details and analysis. All the details and assumptions for the forecast period when we perform a valuation exercise is provided by the management by the client. And it is the most detailed of the three methods and approaches that requires estimates and assumptions on a DCF. It's the discounted cash flow method. Then moving to free cash flow to the firm, basically what does it say? Free cash flow to the firm, free cash flows available to the firm, to the business, to all kind of debt providers, is the amount of cash flows from operations available for distribution after we account for depreciation, expenses, for taxes, working capital, and future capital expenditures that an investment requires. When we aim to perform to estimate the equity value, we go to the free cash flow of equity. It measures how much cash is available to the equity shareholders of a company after all expenses, reinvestment, debt is paid. The free cash flow to equity is a measure of equity capital usage. And then we have the dividend discount model, which basically predicts the price of the company stock based on the theory that it presents day price is worth the sum of its future dividend payments, and basically it calculates the shareholders' value. When are these methods? What are some specifics? I would say first description, some specifics of the income approach. As we said, the technique or the method to utilize under the income approach is a discounted cash flow method. We require a business plan here, 5 to 10 years, and we use as well terminal value calculation. It is focused on cash returns. In order to discount the future cash flows at present value, we need a discount rate, which we calculate in-house as well, or utilizing templates and methodologies of CAPAM. It is forward-looking into account. It is also looking at the strategy and growth prospects of a business. When do we use it? The use cases. It could be for startup businesses. It could be for limited life businesses. It can be for mature businesses or for businesses that we know will have a long-term performance. And we know that we can obtain a logic free cash flow estimates for the upcoming 5 to 10 years in order to perform the valuation exercise. What's important, if we move on to the next slide, an important role in utilizing the income approach plays the weighted average cost of capital or the discount rate that we call. WACC is the average rate that a business pays to finance its assets. And I'm pretty sure that you might have heard as well of weighted average cost of capital. It's a financial metric which is used to measure the company's cost of capital by taking into account weights of each component of debt and equity. Is used as well by companies to evaluate investment opportunities and determine through WACC, we determine what is the minimum acceptable return of an investment or a project. Then we have IRR. The concept of an IRR is a discount. I'm sure we all know about this. That is the rate at which the present value of the cash flows equals the initial investment. Is the factor that brings NPV equals to 0. If the IRR or if the IRR, okay, I will reply later. If the IRR of a project is higher than the required rate of return, higher than the WACC, or known as the hurdle rate as well of an entity, what does it mean? What does it mean to us? It means that the project is considered to be a good investment. Even though the IRR of a project or of an investment is lower than the WACC, it means that the project is not considered to be worthwhile because the WACC is the average rate that the business pays to finance its assets. So it's like a threshold. If we move on to next slide, please. If we can move to the other slide, please. Thank you. Okay. For the market approach is the second method widely used to perform valuation exercises. Basically utilizes the value of the business by using one or more methods that compare the subject, our target, our business that we have under valuation, to similar businesses with similar features that could have been sold. Two methods within the market approach, the well-known methods, are guideline public company method and guideline transaction method. And I'm sure that you have heard here about multiples that are used quite often. And the most well-known multiples are EV to EBITDA that we utilize or the EV to revenue. But the highly used, at least on our practice, is EV to EBITDA. The first method, the guideline trading multiples, basically tells us that the value of a company is derived based on actual prices or multiples of similar companies trading in the same market, in public market, where the global transaction, the guideline transaction multiples, is by utilizing by estimating the value of the company by utilizing actual prices or multiples observed on recent transactions. What do we mean by that? We have a recent transaction in power and utilities, which was closed, or in telecoms. I would put a telecom industry. An entity was acquired 7 times the EBITDA. And we have as well to perform evaluation and we will utilize first income approach. We will come up with a value, and impliedly we can calculate what the EV to EBITDA for our subject entity that we have under scope would be 7 times, 3 times, 10 times. Where the market says that such transactions within the telecom industry are taking place at 7 or 8 times EBITDA, we need to understand why our subject entity is deviating from the market. It has to be somehow close. So we understand something is not right with the assumption that we have utilized and so on. As I mentioned, the well-known multiple that we utilize is the EV to EBITDA. It indicates how many times the EBITDA a buyer is willing to pay to acquire the business. And as mentioned, generally investors compare the EV to EBITDA across similar companies or industries with a relative valuation that they have in hands to understand how far or close they are with the market, either with trading multiples or with transaction multiples. And EV to revenue as well, it's another metric that can be used less than EV to EBITDA, because the EV to EBITDA, why it's the widely used multiple, because it captures all the operating cash flows of an entity, where the revenue captures only the revenue part. And basically what it does, it is utilized to evaluate the company's financial worth in connection with its revenue, and indicates how much investors are willing to pay for every dollar that the company sells, for every company sells. If we can move on. And we have the third methodology that we use in performing valuation exercises is the cost approach. Basically, this valuation method estimates the value of a property, asset, or business by determining the cost to replace or reproduce an asset, adjusted for depreciation expenses as well. This approach is based on the principle that a buyer would not pay more for a property than the cost to build something similar with it. That's why even the word itself says cost approach. How much would it cost to rebuild the same business or asset? Is mostly a concept used in real estate valuations. What else? What specifics do we need to make here? And why is it used in mainly real estate? Because there are sometimes companies' prospects could be unforeseen, or a company could be under liquidation. When we have a company under liquidation phases, the cost approach would be best to use, etc. Something that I want you to, because we are closing here with the third methodology that we use in valuation exercises. In real life, when we perform a valuation, we always utilize two methods. As I said, the first method would be the income approach, because we have operating businesses. And the second method would be, as a sanity check purposes, it could be market approach, which is fair enough, close to perform a sanity check. And the reason why we do it is in order to have as more precise numbers as we can. We do it as a sanity check to see that our valuation with the primary method that we did is close to a second methodology, in order to ensure that we have analyzed correctly the assumptions utilized in the business plan. We have performed reasonable checks against historical trends, or we have performed reasonable trends against data that the client gives us in comparison with benchmarks or with the market or with the industry, that this target business, that the valuation exercise we are performing is within the same industry. So there are certain variables and factors that we need to analyze, and to ensure we always perform a secondary valuation methodology to ensure how reasonable is the value that we are providing for a specific business. Then if we can move on. I've included some new things which somehow we may be familiar as well. What are some innovative approaches or aspects in terms of valuation? It's the power of ESG and the power of artificial intelligence, which, as we are all aware of, they have affected our lives, not only our lives in every day, and not only different industries, but they are affecting how certain services are being performed. Let's start with the ESG first. For those that maybe not familiar, they are not familiar with the ESG. ESG stands for environmental, social, and governance, and there are certain factors. These are three central factors that measure the sustainability and societal impact of an investment within a company. What do we mean by environmental factors, and what do they capture? Environmental factors capture how a company impacts the climate, how a company manages waste, and how it manages resources. Social factors, basically, what do they cover? They cover employee relationships, community impact, and customer satisfaction. Governance factors involve broad diversity, executive pay, and shareholders' right. What is ESG factors? The importance of them in terms of valuation. By incorporating ESG factors into valuation, it helps in identifying potential risks that could affect a company's financial performance. Companies that have I would say that in the last years, because this is coming more and more vivid and this is coming more and more of huge importance, companies that have strong ESG practices, they are often more sustainable to perform in the long term than companies who do not have the ESG practices yet. And as we have understood, these ESG practices, for these ESG practices, there is a growing demand from investors for sustainable and ethical investments, making ESG of quite importance in terms of business. And how do we quantify? How do we measure it when we have evaluation exercise? Because these are not quantitatively, but qualitatively. How can we somehow capture the ESG factors within evaluation? If we have an entity that has ESG factors implemented yet, and compare it with another entity, where would we pass it? Because we cannot penalize. And if we are performing the same valuation within an industry for two different competitors, if one competitor has ESG practices in practice and the other entity does not have, well, the entity that has the ESG practices and metrics in place should be somehow worth a bit more than the other entity. So how do we quantify for them in evaluation? We translate the ESG risks and opportunities into monetary terms. This is starting to be more and more easier as time goes by. This helps in understanding the financial implications that the ESG factors have. Another thing would be to adjust the discount rate to reflect ESG risks. Higher ESG risks may lead to higher discount rate. If an entity has high ESG risks, of course, the discount rate that we utilize to calculate, to discount the cash flows should be higher. The scenario analysis involves modeling different ESG scenarios by assessing the potential impacts that this can have on evaluation exercise. And then integrating the ESG metrics into traditional evaluation models provides a more comprehensive view. These are new things that we are trying as well to capture. The ESG practices, of course, as we know, are more are regulated and we see them more in public entities rather than private entities, but even the private entities are putting a lot more effort and focus on these factors as well. And artificial intelligence in terms of valuation, as we all know, that this AI is revolutionizing the field of valuations by enabling advanced data analysis, predictive analysis, and automation. It can process a very large data to identify trends and patterns, which moves somehow from the traditional valuation exercises that we could do. It allows us to do faster historical data analysis and forecast future performance. It improves efficiency and allows analysis to focus on more complex aspects. In the past, with traditional analysis that we would perform, we would perform a lot of research to understand what the market is, to see different sites and sources. We would need a lot of time and days to perform such kind of analysis. Either it could be historical analysis or to understand where the market is going for this specific industry. Now with artificial intelligence and all these kind of databases that are in place, This can be done extremely fast in hours. In less than 2 hours, you can have a view where the historical where the historical trend was, where the future performance is expecting to be. So you create an idea at a very fast time, and it processes very big, large data as well. We have in-house, as EY, we have in-house platforms of artificial intelligence that we use because they have to be credible. We should be careful what kind of analysis and what kind of data, public data or client data we utilize and we put in these databases. So we have in-house applications that we perform. Then how do they impact on valuations? Sorry. Then what the impact they have on valuations? Accuracy. They can have speed, as I mentioned, faster data processing and decision making, and insight by uncovering hidden insights and opportunities through advanced analytics. And the artificial intelligence or these applications with ChatGPT, with Copilot that we have in-house and so on, these are being processed and re-updated on, I would say, on a regular basis, because they take feedback from us as users of these applications in order to see how they can best be fitted to complete and to fulfill our needs. Then moving to the next slide, please. Factors to consider in evaluation exercise. I mentioned two new aspects in evaluation exercise, which they are quite new yet. I cannot say that we do the ESG factors in all kind of evaluations, because our private clients, for example, still don't have the ESG factors in place. It's a very new innovative thing. But there are some traditional factors that are quite important to be utilized in evaluation exercise. If we value a company in 2 different years, we will have 2 different results. And why is that? Because certain factors impact the evaluation exercise. Value is impacted by the current economic conditions, macroeconomic indicators. It is further impacted by industry or sector performance that this business under scope is operating. Value is impacted by the historical analysis, which plays a crucial role in trends and supports the expected forecast or the expected cash flows that this entity is aiming to perform. The profitability level, investment needed, etc. Thus, all these factors play a crucial role to be analyzed before we finalize an exercise. And we perform quite deep dive analysis in all the market, on the industry, that the business that we are performing the evaluation. What is the historical trend? If, for example, the historical trend, revenue and profitability of the entity that we have was somehow normalized in the last 3 years, and then we perform evaluation and the management comes and says that I'm aiming in the upcoming years to boost the revenue by 20%, or my EBITDA margin will move. I had historical EBITDA margin of 10%, and then in the forecast I'm aiming to reach 20%. All these factors, which we need as professionals in the evaluation service line, we need to understand them. It's not that by default, whatever the management says, we just take it, plug in the numbers, and we come up with evaluation. We need to perform a lot of analysis, a lot of understanding. We have several calls with the clients and the management to understand the logic utilized in the forecasts, because they impact the evaluation exercise. So it's very interesting. We build up, when we perform these exercises, we build up Excel models, dynamic, where we can play with the growth rates in terms of revenue, in terms of products. When we can play with the margins. I mean, we can challenge them, where we can challenge all the assumptions of the management against, and we benchmark them with the market so that we understand how close or far we are with the market. Because if the report is for M&A purposes, we as professionals must defend why the growth, if the market, for example, in a specific industry, if the market is foreseen to increase the construction industry is foreseen to increase by 2 or 3% per annum, and our client says that I'm expecting to have a growth rate by 50%, we should be in a position to justify it. We should be in a position, first of all, to understand it, be in a position to somehow to document it in the business plan report, and then believe it. So the value range that we provide has some reasonable basis. If we move on.
So we have the last polling question now. I will launch it.
Okay. Mm-hmm. Okay, so why is it important to clearly state the valuation date? As I mentioned, if we perform a valuation date, if we perform a valuation exercise for the same entity in 2 different years, why this value is different? Mm-hmm. Okay, basically it's what we talked about, that the date is quite important, because the value is impacted by economic factors, is impacted by industry analysis and by industry data, is impacted by future prospects that analysts see for the market. So all these things impact the value of the business for the same business if we perform the value into different years. Think of it as performing a valuation exercise for a business before COVID area and valuation exercise within the COVID area. How things changed, inflation changed, increased drastically. Depending on what kind of service and what kind of business we are talking about, the revenue level was impacted during COVID. For some businesses, it increased. For some businesses, it dropped. So if we compare the valuation of the same business in 2 different timings, the value would be different because it's impacted by certain factors. If we can move on. Okay, the last thing I want to capture is the report structure. When we see any kind of EY reports, basically we will see that we have a specific, a well-defined content, I would say. We have the transmitted letter, we have an executive summary, we perform some market analysis, we have a company overview, we have the management business plan where we explain what the management view was on the business plan. We have a business plan assessment. This section is basically where we as EY analyze the assumptions that the management provided us against the market. That's why we have 2 sections. We have the management business plan and we have the market analysis, where we analyze the management against the market. And we can come up with some kind of amendments. That's why we call it business plan assessment. We assess key operating drivers here in order to determine the feasibility and materialization of the business plan that the management says. Then we come up, after the business plan assessment, we come up with valuation results where we conclude what we have done, what we have challenged, and where the value result is. And then we have in appendix any kind, as appendix, we have any kind of supporting documentation in terms of methodologies used, in terms of transaction multiples, if when we perform sanity check with market approach, and so on. This is basically the structure of the evaluation report that we perform. If we move to the next slide. I think I have a business case just to go quick. If Justin, you can put the project white as a.
I can send it to the chat directly. I can attach it in the chat.
Mhm. Or I can present it if it's a problem.
Yeah, no worries. You can present, and I'll also attach it at the same time so they can access and they can also see an example.
Can I share? Is it okay if I can share, Justin?
Yep, I have also attached it now in the chat. So please, participants, let me know if you can open it and if everything is there. I'll stop sharing now. So if you want, you can also share it.
Okay, just 1 second. Can we all see?
Yep, I can see.
Okay, but this is just, I'll take it in 1 second. What I mentioned, this is the report structure. This is a transmitter letter. And we have the content, table of contents here, where we have executive summary, market analysis, company overview, management business plan, assessment, valuation results, and an appendix. This is how it looks like. These are our colors, the white colors, and we kind of explain, this is the introduction and what we do and what are the methodologies. Then we have some limitations. We come up with a business plan summary. We somehow explain what the management foresees in the market for the upcoming 5-year period or 7-year period, depending on the case. Then we have a business plan risk assessment where basically we analyze big drivers, sales growth rate, gross margin, where the client was, where we want, where the market goes, and stuff like that. We continue our assessment. It can be on EBITDA margin, it can be on CapEx, it can be on working capital, days of working capital, and etc. Then we come up with valuation results. This is the DCF that we perform, the income approach. And this is what I mentioned, that the value always is presented as a value range, minimum to maximum. And this is done through a sensitivity analysis where we perform sensitivity analysis on WACC and cost of WACC, terminal value. We can have some calculations on some sensitivity on EBITDA margin or other key drivers that would challenge a lot the value. And then as a sanity check, if we see market approach, it is done as a sanity check, we come up, excuse me, with market multiples and trading multiples, and we see where this stands and where our company would be. This is the implied of our company. So reversely, from the exercise, from the value range that we have above, we come up with an implied EV to EBITDA. And when we compare our implied EV to EBITDA, It falls within the market that we see in the market. So somehow it gives us the feedback that the valuation exercise performed utilizing the income approach is close to the market view as well. This is pretty much the presentation that I just wanted to, so that you just understand, have a feeling of how the report looks like, what we try to cover as a content and so on. So pretty much from my side, I am done. This was the presentation. I don't know if it was somehow added value for you and if certain things make sense. I'm happy to answer any potential questions that you have. And how do you want me to go? Do you want to read them? Do you guys want to just open videos and take over on questions? Whatever you feel.
Hi, Aura. Actually, we are trying to respond some of the technical questions or regarding the questions about participation, but I can see that there is one question on the chat box, and Levon is asking that could you share some suggestion on what are the most important things, indicators to focus on when doing a financial analysis of a company? So this is the question that might be useful if you can answer this.
The most important factor that we can consider when we perform evaluation is to carefully assess the business that we are valuing, the business that we are performing evaluation exercise in terms of financial performance, where the revenue is going to be, where the revenue growth was in the past, how is the market expecting to develop in the future. Then we jump into profitability because the valuation is performed, the primary method is the income approach. So it's the calculation of free cash flows brought at present value. All these metrics play a huge role. The profitability of a business plan in the forecast plays a very huge role on analyzing and understanding the financial metrics, revenue growth, financial metrics, gross margin, EBITDA margin. Where is the working capital going? Where is is the company performing the necessary capex that is needed? I don't know if I have answered the question, but these are mainly the important factors to look.
Thank you. And we have another question, Luciana asking that how many people are working in evaluation project in EY and how much time does it take to complete the project? Also for a junior level position in SAT department, how does this help in the project?
Basically, to perform evaluation exercise, we can have 3 people in the team, assistant, senior, and manager level, where the manager will have the overall day-to-day with and the overall management of the project and the communication with the client. The assistant and the senior level work together. It's on-job training as well. It takes pretty much depends on the valuation and the complexity of the valuation, but I'm talking about a simple valuation. It can take 3 to 4 weeks to complete and deliver the draft or final reports to a client. And how the more junior level support, they support in market analysis, they support in financial analysis. When we say company overview, we perform some financial analysis on the historical performance of the company, as well as the forecasted projections of the company. So the more assistant levels fully support on this, where the senior level will the work related to the senior level will be mainly to develop the model, to develop the business, to develop the Excel model, and try to calculate, to perform the discounted cash flow method. It would be more on the Excel part. And as time goes by, as the assistants become more experienced and gain more in-house training on day-to-day jobs, they start taking as well over the financial model, the DCF, to perform the DCF.
Thank you. And we have another question from Daniar. Good evening. How we can use multipliers if we have negative EBITDA of an entity?
if we have negative EBITDA of an entity, we have going concern issues. It means that the company is not profitable. So we cannot use them. It means that the company is losing value. We have cases that, for example, we have an entity in the historical period that they had an EBITDA, let's assume, of 1 million per year. And then due to COVID area, we have the company, somehow it wasn't the area of such business. The revenue level dropped a lot and the EBITDA margin and the company started to be a negative in terms of financial statements and in terms of profitability. For 2 to 3 years, let's assume in the forecast that the company was negative, had a negative EBITDA. After that, after COVID area, 3 to 4 years, which took, the company somehow starts to revert to historical levels. So the EBITDA will somehow be converted to historical levels and be positive again. So what we do, we don't apply the EBITDA of the year that was negative as a sanity check, but we discount the EBITDA in the future, we bring it at present value, and somehow we perform that future EBITDA discounted to calculate the implied EV to EBITDA multiple. Because on a negative EV to EBITDA multiple, it wouldn't make sense. The company is not generating nothing.
Great, great. It's great to see some interactions. We have some other questions. And Zandos asking that in a team involved in the valuation process, who is responsible for preparing the presentation, and valuation participants or a professional designer?
The valuation report is performed. We always work as a team, so it's not an independent work. Never. It's always teamwork, and the report is divided in sections. There are some sections that can be performed by an assistant level, some sections that can be performed from senior level, and some more advanced, which needs somehow effort from more managerial level. And then the final review is performed by the most manager level, the most advanced level, but it's a teamwork. So depending on the level that are joining, the forces that are joining to perform a valuation exercise, it is divided in parts. We give full guidance on what to be done in each slide, how we do it. We put insert boxes because now we have even the remote working a lot, and we're all familiar and used with it. So we put boxes in the presentation with names, and we somehow perform it as a team. A report, it's not done by one person.
Thank you. And there is another question. If the company operates on emerging markets where reliable data is limited, or there aren't many comparable companies in the market, how do you approach the valuation?
If we don't have a lot of comparable data, we approach the valuation with the income approach, first of all, and we should be very carefully because first of all, there is no industry that we cannot find something. We cannot find any potential assumptions for the future on any comparables, but we have cases where the comparable companies are very limited, so you cannot come up with a good benchmark. So we utilize the income approach. We are very, very strict and very careful on the assumptions that are utilized. What management says, it has to follow somehow the historical part, or they should extremely prepare a strategy justifying where the business is going, so that we have somehow supporting documentation for this in the business plan. And as a sanity check, what we do here, we inform the client that we see some risks, and we perform analysis report or scenario analysis. We come up with a more optimistic scenario. We come up with management, a more optimistic and a more pessimistic. And we come up with a value range here by utilizing probabilities. That in case these certain things will not be implemented, then the value would be at this range. We go with a probability view then. If no benchmarks or following market data or market approach can be found.
And we also received that, can we run the valuation exercise together within that course or any other to learn the process? Actually, within that course, we have a certain agenda, but we would like to consider this and to arrange another event together with you to have this opportunity with you and go through a project exercises together. Thank you very much for your interest, and we will take this into consideration. And so I'm also checking the other questions. So Anna is asking that, does EY use AI legally? Because you use private companies' data and share with the third-party companies.
We don't share the client data with third parties. We have only, if we want to use something in artificial intelligence or to perform some research, we have internal databases, ChatGPT, Copilot, where we can rearrange or perform some data management of data, but we do not use Google ChatGPT or Google artificial intelligence. No. We are very strict with confidentiality. We are very strict with client data. They never go public.
Yeah.
It's a must, and it's a must, and it's something that we do have full restrictions inside the company, and something that we fully train the new joiners how to manage the third-party data.
Thank you. And we have last two questions. How can the evaluation be used to improve business performance or strategic decision making?
When an entity wants, for example, in strategic decisions, we have an entity and they are aiming to buy or to enter in a new industry, or they are aiming to acquire a new industry. This is a strategic decision. How do we support them with evaluation? They come up and ask them that our strategy or our strategy department believes that despite the service line that we have, we want to enter into a new service or into a new distribution channel, and please support us. The first thing that we can come up, we have the strategy department as well, where we can develop the strategy. And how the valuations here work, once the strategy department identifies what kind of next actions and moves are going to be done, they may come up with entering into new markets. The strategy can come up with entering into a new business. So before entering into a new business, the client will ask our advice and our support. Okay, that's good. I will buy this entity because it diversifies my product portfolio. But is it worth buying it? So we perform a business valuation to see whether or not is feasible for the client to enter into a new business service line. We perform market analysis there. We perform business valuation. We see certain assumptions that are going to be utilized. We see what kind of synergies the new client will have with the new foreseen business to acquire. And we take into account all of these things.
Thank you. And another question is, how often is simulation performed?
What do we mean how often the simulation is performed?
Rana, would you like to speak up?
If you can help me a bit more with the question.
Maybe she would like to put on the chat. So I just see a final question. Are you developing an internal your own AI as Deloitte, for example, in order to protect privacy of the clients?
Yes.
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 Yes. Very final question. We are receiving a lot of questions, so it's really nice to see this interest. What are your advice on preparing for a junior level position in the SAT department? Actually, on the last day of our session, we will have a session about how you can build a career in EY, how you can search the roles, but it will be great to hear from your advice.
Yes. How the most junior levels can prepare is I cannot say only for I understand that the question is not only relating to business valuation, but in general for SAT. First of all, to really understand what we do at SAT, and I would say that if you love joining SAT, and you understand what we do in every day, because that's why all these trainings and these workshops are being done, so that you have an understanding and the feeling what we do in business valuation, what we do in capital equipment, what we do in strategy, and so on, all these themes. If you identify what kind of topic and what kind of service you would like more to do, some like preparatory thing that you can do is just to read somehow certain books, and I will provide you here in the link to related to business valuation now, Damodar and Ashworth and IVS, which they provide full deep dive analysis of what valuation is, how we do it, just to become more familiar. I wouldn't say that you need a lot of preparation to join SAT, because you take the in-house training in all projects. We have different levels. We have excellent teams. And the more you like it and the more you love it, I think you excel at it. So that's my message, that there is nothing big to prepare to join the SAT. You should love Excel, definitely. It's mandatory. We live with Excel. So you should you should be an Excel lover, I would say, because it's widely used. You should like research. You should like the challenge, because we never have the same project over and over again. It's not like in audit, or you have you have repetitive clients. We have new clients, we have new valuation, we have new industries once in a while. So you should love market research. You should love the challenge. You should love being flexible. You should be somehow a flexible character as well. So all these things support, but in terms of reading and some kind of preparation that you can do for business valuation, I can provide in chat here two sites. That you can Google. It's purely Google that you can do. And they provide you a lot of theory that you can prepare, that you can read, you can enhance your knowledge about it. You guys can take it from the chat, the two links that you can look specifically for business valuation. But I would say that as I mentioned, I have 9 years in EY and 2.5 years at Deloitte. I really love what I do. I find it fascinating. I find it developing. I think that even in my position, I cannot say that I've seen everything and there's nothing to learn. So as I grow up, I see new things. I see challenging things. I always develop myself as well. So it's a fascinating department to join, to excel your knowledge, to excel yourself as a profession, and gradually to find which part of SAT fits all of you as a character, and what makes you happy to start working in the morning. And this is something that I tell to my team as well, that once you start not liking and not wanting to come in the morning to work, then I would be worried. Because I want everyone that's coming to work to be happy. I want them to love what they do, because only if you love what you do, then you will excel at it. That's about it.
Great. Great. Thank you so much. I can see that there's a hands up. Natalie, would you like to speak up before we close the session?
Yes, thank you so much. First of all, thank you so much for the whole seminar. I hope you can hear me.
Yes, we can hear you.
Okay, perfect. I wanted to ask about the artificial intelligence, whether you view it as an asset or a threat for young applicants such as us? Because you mentioned that we should be Excel lovers, and I really like Excel, but I'm scared that artificial intelligence might take away some of the fun stuff you can build there and develop yourself.
I don't think that, of course, artificial intelligence, you should not, the new level should not see it as a threat. It's a tool that makes our life easier. It's a tool that speeds up the work that we do. And our job is to understand how to best utilize it. Even for me, even for the more junior members that I have in the team, our job is to understand how fast to utilize it, so that something that it could in the past to take us 3 to 4 weeks to do it, we can come up and do it in 2 weeks. This allows us to take more work to do. But you shouldn't see it as a threat. You should see it as a tool that makes our life easier.
Thank you so much for the answer.
At least how that I see. That's how I see it. That we should excel on how good we can utilize such tools to support and create value for our clients. Because at the end of the day, that's what we try to do, value creation for the clients.
Thank you. Thank you so much for this excellent information, and all the participants. Thank you for all of you, because you were very interested, very interactive. So we already run out of our session, and you stay until this time. And you will see the invitation to your emails for the tomorrow session. So we will be together tomorrow. And so it will be great to see you again. And I think we can now close the session for today.
Thank you very much. Thank you very much to everyone. I wish you best of luck in your studies. Enjoy as much as you can. It was a pleasure for me to be a speaker today for you, and I hope I created some value added for whatever kind of small knowledge that I could have provided today. And I really hope in the future that I can see some of you guys joining UI premises, wherever this can be, in whatever country. It would be really fascinating. It's an excellent experience for all of you to commence your career with and to excel in the future.
Thank you. Thank you so much, Aurora.
Thank you. Have a nice evening to everyone, and happy holidays as well.
Yeah. Thank you. Have a great
Thank you
rest
very
of the
much.
day.
Bye.
Bye. Thank you.
Thank you
Bye-bye.
very much.
Goodbye.
Bye.
Thanks. Bye. Have a great evening.
Bye.
Merry Christmas.
Merry Christmas.